Hello all. This is Venkatesh Deshpande. This is my second lecture on different asset classes. So as this series belongs to long-term wealth creation for financial freedom, and also as I noticed last video which I posted, it was a lecture session for some of my students, and I noticed that I did not introduce myself onto this video. So let me take that as an opportunity to introduce myself to you. Yeah, my name is Venkatesh Deshpande. I am actually by profession a software engineer, and now working with a very large multinational company, and having 14 years plus of experience both in software engineering as well as the financial literacy. So it's been 2004. I'm in, the rather you can say stock market, or the active investing career. Since my first job uh, here till here, so I'm on this path where I enjoyed both my profession, which is software engineering, as well as the wealth building process. And having put together these 14-15 years of experience in both the areas, so I loved each one of them. And then particularly the long-term wealth creation, and is my very larger goal going forward. So for this I have read a lot of books, and I myself got to know a lot of things with my mistakes. And my early part of my journey was full of mistakes, right? So you will always learn through your mistakes. And so with that, I also had a very good understanding and very good learning process, with which now I can stand here and let you all know that how things work in long-term wealth building process. So having said all this, like if you might have gone through my first video, which is the lecture one on how we should start with financial planning. So in order for us to start with long-term wealth creation process, the very first, the beginning part of our the topic should be, or the understanding, or the the kind of starting point would be, how do I plan my finances, right? So that was the last session. I think if you want to take a look and have that video played again, so you can go ahead and see through it, right? And also my plan is going to be like roll out all these long-term wealth creation video series or the lectures for you guys, uh, to just get a very good understanding about not only stock market, or but one particular asset. It's all about how put together all the financial knowledge which I acquired over 14 to 15 years of my exploration. So I just wanted to reveal everything, every aspect of it, and then so that you can get benefit out of it, right? So let's start with our actual topic of the lecture of discussion today is a different asset classes, right? So, and the interesting part of the asset classes um, is basically these are the tools, or so the way with which one can build the long-term wealth, right? And wealth building is not a short-term process, and I always advocate the long-term wealth building process. So there is nothing like short-term. Overnight you can't be a millionaire, you can't be a rich or wealthy individual. You can be a gambler for a moment, or for a months, or for weeks, but without grand knowledge, grand success can't be achieved, particularly in the wealth creation arena. So let's start with the cryptocurrency from the bottom. So I my plan is to start introducing all possible tools or asset classes, those can be of your use while building the long-term wealth. So nowadays you are hearing a lot of buzz around cryptocurrencies, naming Bitcoin or Ethereum. So I was also maybe like, since it's been long since these currencies are uh, are being traded onto a very big scale. So since around 4 to 5 years back, I first, started taking an interest into what these cryptocurrencies are way back 4 or 5 years back. So then it did not take much of my time or much of my effort to understand this is my this is not my area of competence. As Warren Buffett says, you need to play your own ball game. You can't play others. You can't play others. On other strengths. So you have a particular strength. You have a particular circle of competence, and then you just play into that. So cryptocurrencies, when I started understanding very beginning, I got to know that this is not my area, this is not my field to be in which I use this to create a long-term wealth. So as I mentioned here, no big historical data available because it's recent development. I would say why recent development, because all other instruments which I listed above have at least 100+ years of history, right, in the financial literacy. But cryptocurrency is no is not having particular long span of historic data. And also, when I call risky investment, for example, let's say consider this. So I just wanted to complete uh, my view on cryptocurrencies. It's obviously my view, right? So you can be one among them where you are a fan of cryptocurrencies and you can counter argue with me or on my content that okay, you don't know much about it, hence you're talking about this. Yeah, I agree that I don't know much about it, but what I can tell you is that it won't work out, because there's one person in the world that all of us know, Warren Buffett. If he talks about something, he understands it completely and clearly. With long-standing career or the lifespan he put in, and understanding the financial literacy, I think it is enormous. If he doesn't agree, then I don't want to put my huge effort in understanding how blockchain works and how cryptocurrencies are traded, what value they carry on them, their face value, their face onto the coin, and what they are going to be redeemable after some long standing holdings, right? So I consider cryptocurrency is a worthless coin. It is not even a gold. It's not even a silver coin. It is just a online unit where you will have particular wallet, and when you buy it with huge amount of money, it can be dollar, it can be Indian currency with which you are going to buy it, and then you will get particular currency unit allocated, and you don't know what to do with that until unless somebody buys your currency, right? It won't have any value, right? It is not a money. It's not like money. It is not like a gold coin, so with which you can go to the jeweler, go to any banks if it is pure enough, and just redeem it against your money. Nobody will give you money back if you don't trade the cryptocurrency on a particular channel, right? So this entire development is very ambiguous to me. Hence, for now, for you guys who don't know much about cryptocurrency, don't put your effort there. Is my suggestion. Obviously, somebody who is very expert in this domain can do some short-term trading or can some do some short-term benefit out of it, but I don't know how to do that, and hence it is not at all my area of competence. So cryptocurrency, big no for a beginner, or for one who is serious about creating long-term wealth with no catastrophic risk involved, right? So let's move again upward with the next category or the class, asset class, which is known as debt asset class. Debt asset class, though I have listed bonds, PPF and EPF, right? So these have a long-term average return 8.18 CAGR. When I say CAGR, it's compounded annual growth rate, right? So um, an investor can take this path as well to build a very long-term wealth. So rather, I could say this won't be a very sufficient mechanism or a very sufficient asset class with which we can, it's not an efficient or you can say high return grade asset class with which we can create and build wealth uh, very predictably, beating the inflation, right? There is a concept of inflation involved around here. So when I talk about each uh, category inside that debt instrument, or you can say debt asset class, it can start with very favorite among Indians or across the globe. It's a fixed deposit. The fixed deposit, a recurring deposit, bonds, PPF, EPF, and nowadays we have Sukanya Samriddhi Yojana for a girl child, which has 0.5% of higher return than all of these offerings, as well as there can be NSC, the National Saving Certificate, or Kisan Patra, so many things, right? So why we call them as debt? So these investment, when they made, they will have a fixed return onto their conditions, right? For example, if you want to go for a fixed deposit, you will upfront know that whatever the fixed deposit I'm opening, it has this rate of interest. Similarly, the PPF and EPF, let's for example, PPF, right? Public Provident Fund. Government announces every year a fixed rate of return, a fixed rate of interest for the PPF holder. It can be varying from 6.5 to 9.5, depends on the economic cycle or the inflation scenario, right? So hence, a holder or an investor in these instruments, they know that the fixed interest is being generated out of it, right? So there is no ambiguity on how much the return would be through this test instrument in most of the cases, right? EPF is also same. And when you say bonds, this is some very important aspect of our investing style, where also known as a component in diversified investment portfolio. When we talk about bond, you consider like this. For example, there is a company A which has huge operations, and it produces a lot of goods, and maybe it is of service based company, right? Whenever it needs money, then it has two options. The company has two options. One, it can directly go to the corporate bank and ask, okay, um, so and so company, I do this business and my turnover is this. Please lend some money to me so that I can pay this much interest to you back. Right? This is the one option that company has. There is another option that company has is sell its bond either to corporates or to individuals like us, right? When you buy the company bond, on the bond there is a coupon rate which is fixed. For example, different company may have different interest rate offered to an investor, bondholders. For example, Reliance Industries, it offers the customer who want to own the bonds of the Reliance Industry. They may offer like around 7% interest rate, slightly higher than FDs, slightly higher than PPF, and slightly higher than EPF. If EPF is around 7.5%, Reliance Industries bond can carry around 8 to 8.5%, because it's a big company, very stable company, and hence another 1% can be earned on top of EPF return, right? So these are known as bonds, and I will talk about, see, these themselves, these asset classes themselves are a bigger topics, right? in a short session, I may not be covering about the whole and soul of the bonds. I may not be covering entire aspect of PPF and EPF, but giving an example, as we are beginning with this series, wealth building process, where I want to introduce you, there is a debt type asset class which offers you a fixed return for the long period of time, or the time till you hold those instruments in your portfolio. Okay, in India, we have a historical average return on debt instruments is all about 8.18% CAGR. Okay, so this is also one of the rather decent investing avenue, right? Then up in the bullet, which is gold, right? All of us know gold in India, at least we love gold, both female and male are fond of gold. In Western world, particularly, there is a less importance to the gold, but in Asian subcontinent, we all love gold. But we never treated till now very seriously gold can be an instrument of investment, right? So long-term average return in India for gold is 11.7% CAGR. That is, you can say, kind of just a little bit more on debt instrument, right? Obviously, all these assets, right from gold, real estate, mutual fund, and equity, these are not fixed interest income kind of tools or instruments. When you invest in gold, either it may be in the form of jewelry or it may be in the form of online, or you can say e-form of gold. Even in any of the cases, your returns are not predictable, right? So there is nothing like when you buy a gold today and after 10 years, the gold amount or the gold per gram gold would be of this amount on 10th year of your holding. No. So these are also known as a commodity. Gold is a commodity, right? So it is going to be having its own ups and downs, and based on the market condition, based on the economy, and based on the demand and supply of the gold, the the rate of the gold will be vary, hence the returns as well. So but long-term average return for the gold equity gold asset class is 7.7%, slightly higher or decently higher than the debt instruments. Okay, now coming to the real estate. The so gold and real estate, we know them well, right? So hence, when you talk about real estate, we do take care of a lot of research and what place I need to select for investing in real estate. We will carefully select a particular city, we carefully select a particular locality, and we all try to understand what will the price uh, which is happening, or which is being what is the price on which those real estate properties are being sold in that area. Accordingly, we will take an interest and we'll go and invest in that particular real estate, whether it may be commercial real estate or residential real estate or office space. So basically, when you have a real estate as an asset class in your portfolio, it can also have a decent return generating capability, 7.6% on an average since our long-term Indian history, right? Compounded annual growth rate for real estate can be 11.6%. And recently, at all continental level or the global level, real estate prices are under pressure. It may have you know it may have a very unpredictable market cycles. Real estate is affected with lot of factors, not only in terms of economy and its shape. It also depends hugely on demand and supply, and also uh, intense, you know, job market situation, right? If the job market is very pure, the real estate, particularly the residential real estate, will be of big hit. It will have to, you know, face lot of, you know, downturn when there is a job growth halt. So hence real estate is very risky in terms of predictability, right? It can be a great success if you are lucky enough to find out a particular piece of real estate at a right location at right price, until and unless you are, you know, very expert in selecting and, you know, investing a particular form of real estate, you can't win over, and you mostly will have to, you know, spend a lot of years holding that particular piece in order for you to generate a wealth, right? But a lot of success stories around real estate. It's not like gambling altogether. It's a great avenue, but you need a very huge experience in playing real estate and its intricacy. Okay, so and then next coming to another, you know, important asset class, which is equity oriented or stock oriented, which is known as mutual funds. And when I say mutual fund, the name itself says, all right, so it is mutually funded by large number of participants who wanted to take their exposure to the stock market, and they will lend their own money to a particular manager who manages that fund or the entire pooled money and invest in capable companies to generate wealth over the long period of time. That is mutual fund. A long-term average return in India historically is 11 to 15% compounded annual growth rate for mutual funds. And this is the second best compounder among all the asset classes. When I say second best, obviously the equity is the first among all the asset classes. And it is not only in India. These rules of asset classes holds good across the globe, right? So the cryptocurrency, debt, gold, real estate, mutual fund, equity, all these assets may be asset classes return may be varying in terms of their percentage, but the variance among them is exactly the same uh, across the globe when you compare to the Indian context as well. For example, in US, debt instrument can give you around 4 to 4.5% CAGR. In Indian context, it is 8 into, you know, 8 to 8.8, 8.18%. And same in the gold context, they may have something relatively higher than compared to the debt, and the real estate little bit higher than the gold. And hence in India, the CAGR for mutual fund is around 11 to 15%, but in US or other countries, it can be varying from, you know, 8 to 10%. Why that is happening? Because ours is a growth, you know, growing economy. It's a large growing economy across the globe. Hence, our context is different than the US context or the Japan context, right? Hence, what my point here was, mutual funds and equity investments or the stock market investment are the best asset class over the long term to really compound your wealth and generate large amount of wealth. You know, with ACE, if you have a good understanding about these asset classes, right? When I talk about mutual fund, so it has two forms available right now, which one is active investment and another is passive investment. Passive mutual funds are gaining, you know, traction these days. Passive investments or passive mutual funds are also known as index mutual funds. And active ones, which already know, are the regular mutual funds, where a particular fund manager will use the pool money in order to select a particular stock or a company to invest, and based on its change in the prospectus, he will take a decision to move in and move out from that particular stock. that is known as active mutual, where the manager or the mutual fund manager is actively monitoring those companies' performance over the course of time, and based on the performance, he will make a decision whether to be invested or to quit that particular investment and move those funds anywhere else. So that is known as active mutual fund. And passive investment or passive mutual fund is also known as index mutual fund. What happens in the passive way is, like, there is no manager associated for these particular funds. For example, we all know when we call about Indian indexes like Sensex and Nifty. When we say Sensex, it is a group of 30 companies listed on stock market BSE Sensex. And Nifty, when we call, it is a group of 50 large companies of India trading on the Nifty or Indian stock market, right? NSC, National Stock Exchange, and Bombay Stock Exchange we have. So this Nifty and the Sensex, they have a fixed number of companies, and the passive funds will just use the their allocations proportions to invest the capital in those list of companies falling under Sensex or Nifty. For example, if you have, you take an example of, the Sensex plan or Sensex index fund. So it has 30 large companies in India listed under it, and those 30 large companies are, you know, selected based on their market cap. When I talk about market cap, it is like number of shares multiplied by what is the current price that they have, right? So I will explain you. This is a beginning concept. I'll going forward in every lecture. I will categorize all these asset classes, take one by one, and go in detail to let you know a complete introduction or complete understanding of those asset classes. With that knowledge, you will definitely able to, judge and go ahead to, take your own decision and invest in them, right? So this is a beginning session on the asset classes. Hence, there are two styles of investment happens in mutual fund. One is a regular, also known as active mutual fund, and another is a passive, also known as index mutual fund, where those index mutual funds will run with no fund manager, only the electronic system, where we have a long list of companies falling under Sensex, 30 companies. And if you opted for Nifty plan, it would be of having 50 companies with the largest market cap in India. So your fund, for example, if you invest 10,000 or 5,000 or 15,000, will be proportionately divided in among those companies, those 50 companies, and distributed across, right? So by this, what you can say is, through passive mutual fund investment, you have bought all the 50 companies, with your 5,000 rupees, or you can say 10,000. Your money has divided into a particular portion with which these 50 companies have been allocated in Nifty plan, right? So here there is no magic happens. There is no active selling and acquiring or moving the shares from moving one from one company to another company based on the fund manager decision. Nothing will happen. So these passive funds are gaining a lot of investor attentions nowadays, because the big difference under the active and passive category is the the expense ratio. When you talk about expense ratio, when it is about the fees or the administration charges paid to a mutual fund houses, right? And because mutual fund houses have to manage a large team of experts and a fund manager who is very capable and having a lot of track record in equity investment, and mutual fund companies or asset management companies, They have to pay a large part of the profit for their the team who looks after these investments, right? So for that reason, the active mutual funds will have higher expense ratios. And as index mutual funds or passive investment mutual funds, they have to just to go by the list of companies falling under a particular plan or a category, such as Nifty or Sensex. There is no much decision involved by the fund manager. Hence, there is no need of fund manager where the cost can be saved, and then expense ratio is obviously relatively lesser than that of active mutual fund. And there's lot of discussion or lot of debate happening on mutual funds, and which is best. I mean, is it active mutual fund is good and passive mutual fund is good? We will talk that in a separate session, and that attracts a real investigation through which we can conclude what is best for us, right? That is about mutual. Let's talk about stocks now. Having some background about how mutual fund works, either active or passive, finally the investor money goes to the individual stocks through fund manager in case of mutual funds. So equity investment can be made if an investor has a lot of knowledge around the stock market, how equity investment works, and what are the risk and reward involved. And long-term average return in India historically for equity investments or equity as an asset class is ranging from 12.5% to 16% CAGR. And this is the best known compounder in the world among all the asset classes. And since this this is a largest, you know, or the best, asset class with which we can build a wealth. Having said that, it has a lot of, pros and cons. If you do equity investment without understanding the entire process or the, how the equity market works and all in and out, so then for that you need to really put a lot of learning, your time and your dedication to understand how the stock market works. What is stock? What is company? How it performs? Okay, how to analyze company? When to invest? When not to? What is growth investing? What is value investing? And how how to do fundamental analysis? How to do you know thorough analysis of company's performance? How to understand the balance sheet? How to do check among all the risk that company has right now, and what is its credit rating, how the management thinks about the current performance of the company. Is management is capable of doing and performing a great job over the course of time? When I say time, over the 10 years, 20 years, 15 years, will the management stand firm with the same rate of return what they are achieving right now going forward till next decade? These are all the investigation as a stockholder we need to make. Till the time you attain all these intricacies or very, very minute details of particular stock or a company, it is really hard to invest and earn handsome return on this particular asset class. Hence, the final objective of all of us would be going to an asset class which is going to yield a higher return and a great compounder, but having some risk involved in it. And only we will take this route when we understand the risk, when we understand the reward fully, then we will have a best compounding effect on our wealth, which will be tremendously going faster rate, and that leads financial success, eventually the financial freedom, what we talked about in this, right? Our first goal is to go through all the asset classes individually, and we need to understand ourselves, which kind of investor I am. Will I be able to take risk against the reward which I'm expecting? And will I be able to take more hours to understand and learn the investment process? Or will I be able to understand or digest a sudden variation, or you can say volatility offered through equity investment? Am I having a right knowledge to ask right question on my particular investment, with which I can understand, okay, this suits to my need, and hence understanding all these asset class to go about and to create a long, uh, a great years of compounding. Definitely you need a good amount of time and good amount of thinking, and all also a great introspection that you need to have in order for you to be ready and take on these asset classes. Yeah, I'm going to end this session right now. So we are going to cover not only the asset classes in detail, every one of these in going forward. Also, our final goal is to understand equity market or the stock market in a better way. And all these my 14 to 15 years of experience, which I learned through, I just wanted to take you along with me and make you understand what I learned, both mistakes and my successes. And definitely we all can learn and get a great benefit of this particular era in which we have abundant opportunities when we have a knowledge. Let's tap the knowledge, and rest assured we will reap the benefit. Knowledge is wealth, right? So thank you guys. So keep watching these sessions. Those I think will be very important to you, and for that you may have to. I'll try to post all these videos on YouTube so that you can subscribe yourself, and then can click on a bell icon so that whenever I submit or publish these next series of lectures, you will automatically get notified. And keep learning with me on a real stock market investment approach. Thank you. Bye for now.